ATTOM's Q4 home affordability report, plus 10 major home builder stocks, and BlackRock's message to the masses. You do not want to miss that. Today is Thursday, December 21st, 2023. I'm Byron Lazine, and the hot sheet starts now. Welcome into the hot sheet. Let me know which market you're tuning in live from in the live chat. And if I missed you yesterday inside of BAMX during our live stream, where we broke down all of the show notes from this show, the hot sheet, and how you can use that in your content, don't worry, you can still watch the replay if you're a BAMX member. If you're not a BAMX member, obviously use code hot, or not hot, I'm sorry. Today, use code Frosty because you get a much bigger discount there. Use code Frosty to get 25% off. So use code Frosty, get 25% off the annual. You get grandfathered in at your current rate when you renew, as long as you don't have a gap in membership, and you'll be able to watch things like the replay that we just did yesterday in the hot sheet. Thank you for all of those that were in there. Every single, oh, I'm sorry, I'm not even connected here to my iPad. Every single BAMX member gets access to these show notes from the hot sheet every single day. And this is today's hot sheet show notes, which will be available inside of BAMX. Obviously, go watch that live stream if you'd like some tips on how to utilize these show notes. All right, we've got a packed show today. NAR dropped their existing home sales data. Let's start there and take a look at any improvements and signs of, where we could be heading into 2024 based on current and past data. Right now, existing home sales went up in November 0.8%. Okay, this is the first time we had an increase in the last 5 months. So this ended a 5-month decline, this 0.8% increase in existing home sales, total transactions. This is music to my ears. For what happened in November, that's a good sign that we broke this 5-month decline. And hopefully that will trickle into 2024. Hopefully we'll see that Redfin 24 projection of being more accurate than some of the other ones, where we can not only break above 4 million seasonally adjusted home sales, but we can get up to 4.5 million. That would be such an improvement off of the bottoming out of 23 as it relates to transactions. However, the sales did retreat by 7.3% compared to the same period last year. So if you're looking at transactions compared to last year, of course, this year was a bottoming out. So year over year, down 7.3%, but broke the 5-month slide, and we're up 0.8% month over month. Okay, the median existing home sales price rose 4% from November 22 to $387,600. We continue to see prices just absolutely rip. And this is contrary to many when we talk about this BlackRock topic at the end of the show, which you want to make sure you stay to the end of today's show because this BlackRock topic is fascinating. There's a Reddit thread and a tweet that I'm going to share with you of how bad misinformation can be in real estate. And there's a lot of real estate gurus out there that just were talking about 20% drops in prices in 23 going to happen any day now. Well, it's got to happen in like the next 10 days. Okay. Because the year's over, guys. And it didn't happen. Okay. Prices went up. We set new all-time highs this year on prices. Here's your snapshot from NAR as it relates to November 2023. Of course, all the charts and downloads that we use in this show will be available for you in BAMX. 3.82 million on the seasonally adjusted rate. So going up month over month, 0.8% gives me hope, gives me some type of something to grab onto for 2024. Because I got to tell you, 3.82 million seasonally adjusted is the lowest we've seen in 25 years. It's dramatically too low. You usually every year, last 25 years, you always have 4 million as a floor for seasonally adjusted sales. Dropped under that just a couple of instances. So hopefully this is just a moment in time. Again, I'm rooting for the Redfin projection to be right by the end of 24, being up at 4.5 million. This time next year, being at 4.5 million seasonally adjusted. That would mean that over the next 12 months, we continue to increase on existing home sales. Month over month, we went up 0.8% in a time of year where, it's harder to do that. Year over year, you have obviously being down 7.3%. Inventory across the country went up. Okay. 3.3 months of inventory in November of last year. This November, we have 3.5 months of inventory. Year over year, prices up 387,600. Usually you see inventory up, uh, interest rates up, you know, you would see sales. It'd be easy to say sales go down. Not the case here. It's because we're so starved for inventory. Okay. And this is just like the basic economics that so many of these doom and gloom housing folks can't wrap around their mind. It's very obvious that when you have inventory that has been dismantled, that has been crushed, decimated, doesn't exist in some markets, the homes that are for sale are going to have a competitive nature to how the buyer is selected, and a competitive nature always relates to prices going up. This is very simple supply and demand economics. Some more data out of the NAR NAR report. Existing home sales weakness in October is attributed to the high mortgage rates during the period. So November improving over, October. You can relate to that, is what they're saying. Mortgages obviously since dropping has helped. Properties typically remained on the market 25 days in November. That's slightly up from 23 days in October. Certainly seasonally makes sense. 62% of homes sold in November were on the market for less than a month. So still many homes, 6 out of 10 homes, six plus out of 10 homes moving really fast off the market. Less than a month is a short period of time. First-time buyers accounted for 31% of the sales in November. So first-time home buyers, however they're classifying that, outside of 3 years or true first-time home buyer, making up a large percentage of the market. That's up from 28% in October. All cash represented 27% of transactions in November. So this is starting to come down. Okay. All cash was up around, 30 plus 35% at one time this year. So 27% in November is showing that that's coming down. And in November, what did we see? We saw the mortgage application demand starting to go up. I know in the last week we covered yesterday, mortgage application demand went down, but that's a projection we've covered here in the last couple of weeks that you'll see mortgage demand go up in 24 as more people get comfortable with the rate, and you might see less cash into the market. Another reason for that could be that there's some momentum. There's some, I guess, positivity, some belief that a good place to start putting the money again is going to be into equities, into the stock market. You're seeing the stock market just set a recent all-time high. The Dow did anyways. And, as that 10-year comes down, so people are going to want to go put cash in the stock market. And so maybe real estate purchases are going to be more mortgaged than we've seen this year. It's not going to be a huge swing, but we're just playing the percentages and seeing kind of what happens here. Individual investors or second home buyers purchased 18% of homes in November. That's up from 15% in October. So second home buyers, or just the individual investor, not the institutional. Bombshell news on institutional investors. End of the show. So stick with me for that. But individual investor, your local client who's amassing, a nice little portfolio of 10, 15 homes in the market, as well as second home purchases. That was really 1 out of 5 homes in November were to that clientele. So, just because somebody has bought a home doesn't mean they're not in the game for a second one. Remember that about your database. If you're an agent, a lot of those folks, once they buy one home, they're like, hey, this isn't as hard as maybe I want to get a second one. Maybe I want to get a little bit more income. Maybe I want to build wealth outside of my job in a way that I can understand. And I can understand this. This is something I feel like I can learn more about. I'd be reaching out to all the folks that own homes in your database. See, hey, do you want to be put on my here's a great for agents, you might want to write this down. Here's a great reach out on email or on text to people who in your database who already own a home. Hey, I know you own right now and you're super happy there. Do you want to be put on my investor list where I can send you properties that come on market that might be a great investment? Do you want to be on the investment? Oh, tell me about, right? And what you're doing there is just create a search on your MLS for properties that fit an investment criteria for your market and alert them when these properties come on the market. The more people you can get properties in front of, the more conversations you're going to have on property. So, and you make it sound, hey, do you want to be on an MLS search? No, doesn't sound that attractive. Do you want to be on my investor alert list where I'll notify you of investment opportunities in our market as soon as they come across my desk? That might be interesting. And now the people that raise their hand say yes, you've identified those in your database that could be in this category here of individual investors or second home buyers that are purchasing 18% of the properties in November. Okay, the ones that raise their hand want to be on that list might fit into this category. Okay, the question is, are you going to be the one representing them or not? Median prices varied across regions. Okay, so here we go on median prices across regions in November. You got the Northeast at 428,600. You've got the Midwest at 280,800. It's where you've seen a lot of action demand in the Midwest. You see the South at 351,500 and the West at 603,200. So ranking, top to bottom on highest, median price to lowest, you've got the West over 600,000. You've got the Northeast over 425,000. You've got the South just over 350,000. And then you've got the Midwest at just over 280,000, a tick over. So a lot of folks are seeing value in the Midwest. A lot of investors are seeing value in the Midwest market today. Sales increase in the Midwest and the South. So total sales increased Midwest and South. South would include all the way from Florida to Texas, that whole region there, Sun Belt, but decreased in the Northeast and the West. So sales decreasing in the Northeast and the West. Not as much demand in the West, not nearly enough inventory to meet demand, certainly in the Northeast. NAR chief economist Lawrence Yun anticipates a turnaround in sales. So siding with that Redfin projection that I love so much, citing a recent plunge in mortgage rates, the latest weakness in existing home sales still reflects the buyer bidding process in most of October, when mortgage rates were at a decade high before the actual closings in November. A marked turn can be expected as mortgage rates have plunged in recent weeks. Obviously, the rates have to stay here for this to be a prolonged experience for the housing market. Home prices keep marching higher, says chief economist at NAR. Only dramatic rise in supply will dampen price appreciation. Only a dramatic rise in supply. I've been saying that. We've been saying that here on the Hot Sheet consistently. Where in the world does anybody see a dramatic rise in supply outside of one of the most catastrophic recessions of our time with, enormous job loss? Something like that happens, I could see a dramatic rise in supply, which means then you will see price depreciation. Nobody's rooting for that, of course. A catastrophic recession with enormous job loss. Nobody's rooting for that, right? And there's not many that believe that will happen. There's very, very, very few. Just like the people that believe that will happen, they've been saying that for every single year for their entire careers. This is going to be the year the whole world falls apart, and they just beat that drum over and over again. But every valued economist, market analyst, that's looking at things, is saying, hey, we have a possible of a soft landing here, or maybe a very shallow recession. I mean, that's where the market consensus is. That's where Wall Street's making their bets. They don't lose that much. And so I'm more in that camp of what the recession outcome could look like in 24. Okay, let's get into home affordability. It's obviously one of the most, it's one of the hardest things that we deal with as real estate professionals each and every single day, especially when it comes to our buyers. And it remains difficult across the U.S. during fourth quarter, even as prices could dip downward in some areas. Okay, so ATTOM says here that this is Ron Barber, the CEO for ATTOM. The good news is that home affordability has stopped getting tougher around the U.S., at least for the moment. The bad news is owning a home remains more of a financial stretch than it's been for many years. Okay, the annual fall slowdown in the housing market clearly has helped stem the tide working against potential purchases, more so that the interest rates, whether that's just a temporary thing tied to a seasonal market pattern, is something we don't know until next year. We're going to be looking for data on this as early as mid-January, especially given the signs that interest rates are coming down. But for now, there's some break in the growing financial stress for house hunters. Okay. More on this. Median price single family homes and condos remain less affordable in the fourth quarter of 23 compared to historical averages in 99% of the counties analyzed by ATTOM. Major expenses on median price homes consumed 33.7% of the average national wage in the fourth quarter, reaching a 16-year high. That's the big one to watch. It's like, what percent of my money that I'm bringing in do I got to put into living? And if it's a median price home on the market now, 33.7% of the average national wage is going towards it in the fourth quarter, which is a 16-year high. That being said, most homeowners aren't paying that. Most homeowners, remember, 80% are under 5%. Over 80% are under 5% on a 30-year fixed. It's why we've had this, going back to last segment here with the tightening of existing home sales. It's why we've experienced this kind of tightening of existing home sales, because the best hedge against inflation is just keeping the house you live in. Okay, your living expenses are much less than 33.7% of your wage right now if you own one of those homes, if you're one of those homeowners, or if you're the 42% that don't even have a mortgage on your house. Both historical and current affordability measures have stayed nearly the same from the third quarter to the fourth quarter of 23. Affordability has worsened compared to a year ago and is significantly weaker than 2021, of course, when rates were, fairly lucrative, or were historically lucrative would be a better way to put it. Okay. Some of the regional areas, the top 20 counties with the largest percent of average local wages needed for major home ownership, they were in the Northeast and the West. Makes sense. We just went over prices there. Counties with the largest populations that are unaffordable include LA County, Maricopa County in Phoenix, San Diego County, Orange County, Kings County in Brooklyn, New York. The national median home value has slipped almost 3% in the fourth quarter, but still up 6% from the same period of 22. This is according to ATTOM. Of course, we just went through NAR's numbers there. Annual wages of more than $75,000 are needed to pay for major costs on the median priced homes in 57.2% of the market. So looking for an avatar in your market of who to create relationships with, yeah, annual wages of 75 plus are going to be important if you want to increase transactions in the near term. The income needed to afford median price homes in the U.S. is 20.5% more than the latest average national wage. So that the average national wage not cutting it here. What is continuing to cut it on Wall Street would be homebuilder stocks. Homebuilder stocks are telling us something about the U.S. housing market, according to Lance Lambert from Resi Club. Among the top 10 major homebuilder stocks tracked, 10 outperformed the S&P 500 in 2023. It's a fascinating stat. 10 of 10. Among the 10 major U.S. homebuilder stocks, all 10 outperformed the S&P 500 here this past year. Here are the returns, shift in share prices, 10 of the largest publicly traded homebuilder companies as shown on this table. Century Communities, 4-year return, up over 216%. Okay, this 1 year, last year's return, if you just put, $100 into Century Communities and a year ago, you're going to get 170.4 back, 70.4% 1-year return. Look at Meritage Homes, 93.9% 1-year return. How about Pulte Group, leading the pack on the 1-year return at 128.4% 1-year return. Toll Brothers, 106.3% 1-year return. I mean, Pulte Group at 128.4%. A year ago, you could have went under contract with them on a new construction house. Say it's $1 million, okay? And then, you could have put $300,000 down or whatever, $250,000 down on the $1 million home. say you had $1 million, okay? I've got $1 million cash, and I'm going to buy a house with Pulte Group. It's going to take him a year to build. Okay. I put my $250,000 down on the build. I take the other $750,000 and I put it into Pulte Group stock. I've often said this to agents about like, I don't want to pay Zillow. I'm going to go get my own leads. We'll just put a little money on their, this is back before they went from $10 to $200. I'd say, we'll just put a little money on their stock. And if they're right and you're wrong, you're going to make a lot of money off of them. Okay. So if you put $750,000, I'm just doing some quick math here on the calculator, on Pulte Group at, what is that, 128.4%? 128.4 and how much? 750,000. You'd be, my math isn't working here for some reason. Maybe somebody in the chat can do this for me better than me. Let me get 128. Anyways, 128% on $750,000 is over the $1 million that you're paying for the house, is my point. Okay. So you already got the 250 down. You could have more than doubled up the 750,000. You're going to get $1 million back and pay for the house. That's what happened this year with Pulte Group. Okay. When you take $750,000 and you get 128.4% return, you're returning about 1.25 million profit on that. And you would have paid for the house and for your furniture had you done that. Obviously, hindsight, right? The 4-year return on Pulte is only 166.7%. So a significant amount of their growth here in the 1 year is, happened in the last year. You would have to really see that coming. Toll Brothers at 106+% in the 1-year return, a monster numbers. While the S&P 500 index at the bottom, 4-year return 48.6%, 1-year return 24.8%. Good year to be in the S&P this past year, 24.8%. 4-year return 48.6%. All of these stocks on the 1 year and certainly on the 4-year returns as well have outperformed the S&P 500. Much safer for sure, but if you look back, it's like, hey, man, these builder bets were probably right in front of us if we really think about it, based on where the interest rate was. Now, maybe not as obvious because the interest rate hurts builders as well. But I was beating the drum in the beginning of the year and I didn't see it. I was beating the drum on, this is going to be a lock-in effect. Well, if there's a lock-in effect, I called it the Cold War, people not selling their homes. Well, the ones that have to buy them somewhere. And that ended up being with these national home builders. You can see the acceleration here on the 4-year home builder stocks between December of 19 and December of today. The values that these companies have experienced, most of them all now at new all-time highs. They set highs in 21, 22, had the mortgage rate shock, and then have now just shot back up. And that's due to the inventory crisis, of course. And so the bigger home builders are of course getting much bigger based off of the fact that we haven't been able to keep up on inventory in this country. Okay, BlackRock drops a bombshell statement. BlackRock doing it in just pure black and white, making it obvious for all where they stand. BlackRock and housing setting the record straight is their headline on BlackRock.com. Recently, BlackRock has been subject of speculation, misperception, and even mistaken identity in media reports on social media regarding our role in the U.S. housing market. And so here's the statement. We want to make perfectly clear, BlackRock is not buying individual houses in the U.S. A number of other large asset managers and private equity firms are very active today in purchasing single-family residences. BlackRock is sometimes confused with them. As a fiduciary asset manager, we invest and manage capital on behalf of our clients in a vast array of public and private U.S. real estate markets. but buying individual homes is not one of them. Below are facts on how we do participate in the US real estate market. Combined, we are investing approximately 120 billion in the US residential real estate market on behalf of our clients. So this is how they do it now, not buying individual homes, but this is what they say they are doing. Providing capital for mortgages who can help American families buy new homes. BlackRock is a significant investor in mortgage securities. Okay, so there you go. Providing capital for new housing construction. So, we just looked at those new production builder stocks. They're looking for capital. They're going to BlackRock. They're bringing the inventory to the market. They're watching their stock price go up. Maybe BlackRock on the backside knew to go and buy a little Pulte stock at the beginning of the year, double dip there. I'm not accusing you, BlackRock, of that. I'm just saying that would have been probably a very stealth power move on your point. But here's one way that they're capitalizing on the residential home market is providing capital. So they invest in several programs that are providing financing to build new homes and add to the U.S. housing supply. Look at how BlackRock, they're helping American families buy homes. They're helping the U.S. housing supply. They are playing into the we are here to help card. Most recently, we began investing in new construction purpose-built for rent housing developments that add supply to the market and address the increasing demand we see for this property type. Our focus is on building single-family rental housing that can be managed and operated similarly to multifamily properties with dedicated property management, leasing, and amenities. Okay, so they want to go build, own, manage single family rentals. Okay. I'm sorry, they want to provide that capital to that is what they're saying. Okay. So when, hey, they're going out buying single family homes. Well, they're saying they're not doing that. But they do want to provide capital for building new single family home developments for the sole purpose of leasing those as units with dedicated property management, like you would see on a 1,000-unit, multifamily building. Other U.S. investments, additionally, BlackRock invests in multifamily properties, apartment complexes, and other residential real estate. I don't know what that would mean there. The other, so bottom line, they go as far as going bottom line, black and white, in your face. BlackRock is an active investor in the U.S. real estate market, but we are not among the institutional investors buying single family homes. Period. End of story. What's your take in the comments? Do you believe BlackRock? Because there has been a lot of this type of misinformation. This is a Reddit chain. It also shows a tweet in here from X. This is the kind of information 3 years ago that so many were putting out on online, things like this. And I really tried to slow the hyperbole down because we know that the institutional buyer owns far less than even 3% of the inventory right now, in across the country. So everybody's saying they're buying every single house. It just was never true. They haven't accumulated, that much. BlackRock is buying every single family house they can find, paying 20 to 50% above asking price and outbidding normal home buyers. Why are corporations, pension funds, and property investment groups buying entire neighborhoods out from under the middle class? And so this was basically a Wall Street Journal article that this person was putting their context on top, saying BlackRock is doing this. But Wall Street Journal definitely did stoke the fire of Americans believing that every single family home is being bought up by institutional investors. Of course, on BAM recently, we covered the Congress's move there, and you can find the article on nowbam.com, which is, we talked about it here on the hot sheet. We have an article on it, but Congress's new legislation banning hedge funds from owning single family properties. This is a 10-year phase out bill that has been proposed. I haven't really heard anything about it since the proposals. Not many that believe that it would happen. Here's the scale in which each hedge funds would have to get rid of their single family residences for for purpose of rent, which would also stop BlackRock, I guess, from investing in those types of builds. So there you go. Love to know what your thoughts are. Do you believe BlackRock? They put out a pretty bold statement on their website, making it very clear. Now, they also made it clear that they've got a significant investment into real estate, and maybe they're investing in like companies that are developing these single family rentals. So you might say, well, you're kind of the behind the scenes, company pulling the strings there a little bit. I think the big thing to remember on this is that institutional investors do not own as much real estate, single family homes, as some of these big headlines or some of these, real estate Reddit threads or Twitter threads are making your consumers out to believe. Certainly if you're in an area like a Charlotte, you got to pay closer attention because there's been a lot of attention in that market. And we talked about those numbers where you do see institutional buyers coming in the masses. But most markets in America, 97+% of investment properties are owned by small mom and pop investors that aren't classified as institutional. Institutional is over 1,000 homes. So, could you have a guy next door that owns 100 units in your town? Yeah, that's not an institutional. That's a small mom and pop. That's capitalism at its best. That's somebody who's taking advantage of the best loan product in the country, which is America's 30-year fix and probably a lot of refinances and played the rollover game. It probably took him or her multiple decades to do that. But that is not an institutional investor. That is a small mom and pop. And the majority of properties in America are still owned by small investors. Obviously, there's been more attention from institutional since 2012 to today, but it still hasn't eaten up a significant chunk. Just like we knew that when iBuyers came out, that wasn't going to eat up a significant chunk. There was projections from somebody who has a pretty large media company that said it was going to be 50% of purchases. I laughed that off a couple of years ago, and that was the year iBuying, just went into the tank. So there you go on that. Let's take a look at the 10-year here today. Got a little bit better yesterday, up a tick this morning, but 3.865, we'll take that. It's outstanding. Hopefully we continue to see downward pressure on the 10-year, because we know what that does in relation to the 30-year fixed rate, which yesterday we ended at 6.64, just straight up, same reading as Tuesday's December 19th reading of 6.64. So we've been at 662 on December 14th to 664 in that, 18th at 665. I mean, 3 readings out of the last 5 at 6.64. So huge consistency. Today we'll get the 30-year fixed Freddie Mac weekly survey. I expect that to be lower than the last one of 6.95. Looking forward tomorrow to closing out the week with you here on the Hot Sheet on a free format Friday, as well as closing out the year with you for the Hot Sheet. Next week on the short holiday week, we are going to take the week off on the Hot Sheet. Now, I know we said at the beginning of the year, we're going to do every single day that the market is open, and technically the market is open Tuesday through Friday, but we don't expect major news to be covered during that week. We want to take the week here on the back end to make this show even better. We have some plans to significantly change this show in year 2, which will be 2024. If major news breaks, trust me, I will be going live. I will be in the studio here and working on next year's show with our producer, Bobby, with our senior editor, Vanessa, who was part of the live stream for the show notes yesterday. And so if something breaks, we'll go live. We'll turn on the machine here at BAM and get the information out. But bearing any of that, we're going to be taking the week off of the Hot Sheet next week. So tomorrow will be the last show of the year. Hit subscribe, hit the notification bell so you don't miss tomorrow, and you don't miss if we do happen to go live next week on any breaking news. Appreciate you guys. Can't wait to close out the year with you tomorrow here on the Hot Sheet. Have a great day. And until then, toodaloo.